this video, I will walk you through my proven open, high, low, close model. And you can use this model to master your daily bias and be on the right side of the market all the time. You can use this to get funded, profitable, payouts, all that stuff. And I use this exact model to gain over $1 million in funding and over $100,000 in profits. No time to waste, let's get into it. The open, high, low, close model is all around one single candle, because a bullish candle on the left side has a open, a low, a high, and a close. Just like a bearish candle has an open, a high, a low, and a close. And by anticipating the next candle to be a bullish or bearish candle, you can play the open, high, low, close model. And the goal is to trade the distribution phase, the body of the candle. So for example, here we have a open of the candle, we have accumulation, then we manipulate trading lower into a key level, making the low of the candle, and then we displace upwards, starting the distribution of the candle. If you know the classic AMD, this is exactly this. Same for a bearish candle. You have an open, accumulation, we manipulate, creating the high of the candle, and then we distribute lower, creating the low of the candle. And the key here is to wait for manipulation into a key level. And what's a key level? For a bullish candle, it's in the discount array. That means old low, bullish for value gap, bullish order, bullish breaker. Vice versa for shorts. A bearish candle, you wait for a premium level. That's an old high, or a bearish value gap, bearish order block. You get the point. When price hits that key level, you wait for a market structure shift, the last swing high that made the low, or the last swing low that made the high. And bonus points if in this key level there's an SMT created, aggressive sells, aggressive buys, smart money reversal. If you're not sure what that is, I have dedicated videos to market maker models and to key levels here on the channel. And now the main question, how do you use this? You can use this for a weekly candle, a daily candle, and a 4-hour candle. And for a weekly candle, this candle is just 1 week. And that means if you have a weekly candle and you expect the next week to be a bullish week, you wait for Monday and Tuesday to be accumulating or manipulating. So on Monday or Tuesday, low of the week. You wait for the market structure shift to then trade the rest of the week into the distribution phase. Same for bearish, Monday and or Tuesday, sometimes also Wednesday. Most of the time it's Monday or Tuesday, accumulation, manipulation, and then we start distributing. Meaning that Monday in general is not the highest probability trading day of the week because you are accumulating or manipulating. And you do exactly the same when you predict the next daily candle. If you expect a daily candle to be bullish, you play a classic Judas swing. That means the Asian session is the accumulation, the London session or the New York session is the manipulation, and then we start distributing. Same for shorts, Asia, London, New York, the classic Judas swing. And you can even drop to the 4-hour to play exactly the same. But this is what I do on the indices, on NASDAQ and ES. You can play the 4-hour candle because at 10 a.m. during the New York Open, there's a new 4-hour candle created. And if you anticipate the next candle to be bullish or bearish, you can play the first 30 minutes to an hour to be the accumulation or the manipulation, and then start the distribution as a scalping model. And we'll go over weekly, daily, and 4-hour examples later in this video. But first, let's answer some other questions. And the first question is how to determine key levels. So what you need to do every single week at the start of the week, you mark out the recent key levels on the daily, weekly, and monthly. And I do this as part of my weekly outlook, and I really recommend you do the same every Monday or every Sunday. Go to the higher time frame, all the pairs you like to trade. On the right side, I have my whole list. I go through all these pairs, going to the daily, weekly, monthly to see which one looks nice. And make it easy. Only focus on recent highs and lows and for value gaps. I do this every single week as part of my outlook. I go over all the Forex pairs and do exactly this. Daily, weekly, monthly, old highs and lows, and for value gaps. Because when you know where the key levels are in the higher time frame, then is where you can drop to the lower time frame to insert your favorite entry models, like this open, high, low, close model. So here on the dollar, I'm currently slightly bearish, but overall pretty neutral, because on the monthly we're rejecting, on the weekly and daily we're pretty bearish. So I would lean towards bearish, but in general, I'm not going to be engaging very aggressively into the dollar pairs right now. I want to see more displacement to the downside before I'm going to engage in shorts here. And let's pick another example. Here at Euro NTD, we are currently at the monthly time frame. And what you see is that we swept a monthly level, that is the 2020 high, and also we have a monthly bullish for value gap sitting right there. Cool. So on the monthly, old high and value gap marked out. Cool. Let's drop to the weekly. Here on the weekly, on the bearish side, there's no value gaps. I see a bullish for value gap there. Of course, it's the same high that's been taken also on the weekly. Here we have an overlapping weekly and monthly for value gap right there. Cool. So that's marked out. Let's drop to the daily. The daily, we have some bearish for value gaps here. We've been tagged, but there's no follow through. It just starts consolidating. So because of that, I'm going to be neutral. I'm going to be neutral, slightly bearish towards that monthly bullish for value gap, but we already traded into a weekly value gap. So there's a trade-off here between bearish and bullish. I'm neutral because we already swept external range liquidity. We already traded into internal range liquidity on a weekly. So then I'm not going to drop to the lower time frame to find my open, high, low, close model. When I would engage is when we, for example, now trading lower, sweeping these daily lows into that monthly value gap, and then we break structure. There is where I'm 100% going to engage back to this high. But for now, I'm neutral, so it's not on the list. And you go through this whole list doing exactly this to mark out the key levels. And now we know how to identify the key levels, and make sure you do this as part of your weekly outlook. You know that the goal is to trade distribution phase of the candle. You know, you need to wait for manipulation to key level, for market structure shift, and ideally with SMT. Let's now answer the most important question of this video: how to anticipate if something is going to be a bullish or a bearish candle. And for that, we need to tap on the topic of liquidity. And I have a dedicated video to draw on liquidity here on this YouTube channel, but let's do a quick recap. The biggest mistakes traders make is that they trade in a consolidation. So if on a daily, weekly, or monthly we are consolidating, it is not a good idea to drop to the lower time frame. And the single reason for this is that your PD arrays are not going to be followed through as clean as they would if there was a trending condition. So if you're not sure what consolidation is, this consolidation and this is trending, and you want trending conditions. So you want trending conditions, and you can use for value gaps and old highs or lows. You can use for value gaps as a place to trade from. So price steps to the value gap, and you use that too long. So once we are bullish, every time price trades back into a bullish value gap, there is where I'm going to use my open, low, high, close model, because we're trending and I'm anticipating a bullish candle. Same for if we're bearish. Every time we are here, I'm going to look for a bearish open, high, low, close, trading from an old high or value gap back into the range, or just following the continuation. Because price only does two things. It trades to internal range liquidity, imbalances for value gaps, or it trades to external range liquidity, old highs and lows. And remember, when identifying key levels, all we did was going through daily, weekly, monthly, and mark out old highs and lows, external range liquidity, and for value gaps, internal range liquidity. And you use time frame alignment for your actual execution. So if you have a daily or weekly array, you can use 1 hour structures more for the swing traders. If you're 4 hour array, you can use 15-minute entries. And if you're 1 hour array, you can even go to the 1 and 5 minutes. But more on that in the examples we're gonna discuss later in this video. Bonus points is follow displacement in order flow. When bullish, go long. When bearish, go short. So if you are trending on a higher time frame, try not to short that. Try just wait for the retracements. Same for bearish. Wait for the retracements and go short. In a trending move, the opposing arrays should fail. So if we are bullish and we just had sell side of the curve, buy side of the curve, we just tried to do a key level. What you want to see is that your discount arrays, your bullish value gap, bullish order book, bullish breakers are holding, while the premium arrays, the bearish arrays, are failing. That's what you want to see. So especially here on the smart money reversal, here's where you want to see the premium arrays failing and discount arrays holding, because that's indicating that you probably have a reversal on your hands. Pair this with SMT and you should be golden. So once price taps into a fair value gap or an old low here, I'm anticipating a potential reversal, or at least a reaction to take a long from. And not only can you use this to catch here at bottom here, to expect a reversal on the bottom, what you also can do, use the next candle as your open, high, low, close. So let's say this candle trades into an old high and it rejects. You can use the next candle to be anticipating that it's going to be a bearish candle back into a fair value gap. Cool, now let's dive into some examples to see this on the chart, starting with a weekly open, high, low, close. Here in this first example, we're looking at the open, high, low, close model on the weekly time frame. So that means on a weekly candle, if you expect a bullish candle, you want an open, low, high, close. And ideally on Monday or Tuesday, we made the manipulation move, set a low of the week in a key level, and then trade higher. So here we're looking at this Euro-US-dollar daily chart, and look at how bullish we are. So that means we want to continue bullish. We want to play an internal range liquidity to external range liquidity. And here on Friday, we set this high, and then on Monday, we have a doji candle. So that's overlapping with the accumulation. So on Tuesday or Wednesday, we want price to trade into this value gap or this value gap to then trade to the high. So knowing this, let's drop to the lower time frame to see if we can find an entry around this exact bias. So we want Tuesday or Wednesday to set a low of the week inside these key levels. Now let's take a look at the 1 hour. Same price action then on the 1 hour, and let's see what price gives us. So here we are at Monday, Asia. Let's drop into London. And here during Tuesday in New York session, we drop into that first day for value gap. And we don't need to catch bottoms. We need to wait for price to give us the indication that we want to go long. And that means aggressive sells, aggressive buys, a potential smart money reversal. Once the displacement. And here we get that. So here we have the order block, a breaker here. We have a value gap that could be a breakaway gap right there. We have an order block right here, the series of down close candles that trade to the highs. And we're doing this on the 1 hour right now. You can also drop to the 5-minute to find a smaller entry, to find a more specific entry down here. But we're just doing this on a 1 hour. We just need to know our buys based on the open, low, high, close. Because this on Tuesday, sweeping Monday low, could be a low of the week inside the key level to trade towards these highs. Awesome, that is your bias from a weekly open, high, low, close model. So let's say you take your trade already here on the order block and breaker. You have your TP at the highs and you have your stop loss for 1 to 2 here below the lows. And let's see what price gives us. So we consolidate. This is the Asian session in London on Wednesday. So it's choppy Wednesday here. So for the whole week we're consolidating. So this is not a very nice trade, but hey, you are in. And sometimes you just don't know if you can get choppy price action. You just know your model. You know, okay, this could be a potential low of the week. Let's see if we can trade to the highs. If that's not the case, yeah, you just are in choppy price action. That's part of it. And eventually price trades to the highs. So with choppy delivery, we still caught the low of the week. Why? Based on a daily internal to external higher time frame. And around that, we play a weekly open, high, low, close. So looking back here, we have a Monday consolidation, Tuesday manipulation, and the distribution starts the rest of the week. And the cool part is here, you know how the 1 hour was so choppy. Look at how clean this daily looks. That's the power of this. So just knowing your higher time frame bias will get you the money in these kind of scenarios. Let's now take a look at a open, high, low, close model on the daily. Now we're looking at gold on the daily time frame. And there's a cool indicator. It's called power of 3. You can see it on the top left corner here. And it will give you the current candle here on the daily. So if you double click it, you can even go to another time frame because we're doing this on the daily. You can see here how the daily currently looks like. And what do we see? We see price trading lower, but we have a very bullish move here on gold. So I would say this is a retracement. So I want to steal long and we're coming into this kind of the range, OT, optimal trade entry. And we are trading in a daily bullish fair value gap. And we also here have a order block, these series down close candles. Let's mark out this chart, the body here. So in this area, I'm expecting price to make a low. And then you know, okay, the open high low close model, we're looking for a bullish candle after we hit this area. So we already hit this here. So then what we want to see is on the daily, Asia, London lower into the key level. That could be somewhere here. And then start to distribute towards the highs. Open, low, high, close on the daily. So let's drop to the lower time frame, let's say to the 5-minute, to see how we can frame a bias around this. Now look at gold at the 5-minute chart at the start of the London session here at 1. Let's go a little further to 2. And here we are in that area of the daily fair value gap and daily order block. From this point, you can expect some form of reaction. What we want to see is price opens, manipulates lower, and we just wait for that displacement higher, breaking structure, leaving fair value gaps. Nothing complicated here. So see what price gives us. Here we have something. Aggressive sells, aggressive buys. We break structure right here. We are in a key level. Why is it a key level? This is an overlapping daily bullish fair value gap, bullish order block. So you can already take your entry here at the start of the order block right there. Let's see if price even wants to test a discount array right here. So here we are in overlapping fair value gap and order block. See what price gives us here. It goes to the bottom fair value gap here. So in this area, you could take your entry. Most of the time, I take my entry just here, right here already. So I was in drawdown, stop below the low, target 1 to 2. So let's say these highs, open, low, high, close. I think you can even go to these failure swings. If you've seen my liquidity video, this is all low resistance liquidity, failure swings. So you can even make a monster trade out of this. This is exactly a trade I took myself. You can see the execution on my Twitter and on in the school group. But let's say low hanging fruit right there, open, low. And now we're going to see if we can get the distribution. We're still in London session, target Asia higher. And there you go. All using open, high, low, close in a key level. So zooming out, remember what we want to see? We want to see price trading into this area down the lower time frame. On the daily open, high, low, close, so Asia accumulation, London manipulation into a key level, what we saw the manipulation, we saw low being formed, aggressive sells, aggressive buys, and we took the entry accordingly. It's all based on the open, high, low, close coming into a key level right here, overlapping daily order block and fair value gap. And as you can see, the daily candle printed like this, open, low, high, close. And I will do exactly the same on the 4-hour time frame. And this is one of my scalping models, and we do exactly the same, but then with a 4-hour open, high, low, close. So right here, we are really bullish here on ES, and we have an overlapping 4-hour fair value gap and order block. So what it means, on the 4-hour, the next 4-hour candle, I want to see an open, I want to see a low into a key level. That can be somewhere here, ideally in the bullish order block, but we can already trade the fair value gap, then break structure and go to the upside. So exactly the same. Let's drop to the 1 minute, to the lower time frame, and you can do the same on the 5 minute. Do whatever your preferred entry model is, because the execution on the 1 or 5 minutes won't make a huge difference in your long-term win rate. So you can use both the 1 and the 5 minutes for this one. Same as you can use the 5 minute, the 1 minute for the daily open, high, low, close as well. The open, high, low, close model is based around creating a bias, a high probability bias. So the execution around that bias can be on a 1, the 5, the 50 minute, on a 2, 3, 4 minute, doesn't really matter. We're now looking at the same price action on ES at the end of the London session. We're approaching 4 a.m. and let's see if we create some structure. So what we want to see is aggressive sells, aggressive buys. We want to see a low created. So here we have some accumulation here, consolidation. I want to see aggressive sells, aggressive buys. Where do we get that? We tap the order block right now. Could be something. And this looks like we want to create a low. Why? We take some in this key level, overlapping 4-hour value gap order block. We sweep some short-term liquidity, and then we start breaking upwards. So from this point, let's see if the rates are holding. See a bullish value gap right here. Let's see if we can trade back into it or we just leave. It doesn't look like we want to trade back into this. Why? Because there's an order block sitting right here. We tap that here and we get another fair value gap. So then what I want to do is, based on this open, high, low, close, we can already take an entry right there. But the key is at the new 4-hour candle. On the indices, a new 4-hour candle is created on the 2 a.m., 6 a.m., and 10 a.m. So here we are starting with the new 6 a.m. candle to create an open, low, high, close. Because based on this move, I'm expecting this to be the low of the day. So I want this low to be protected. So my stop loss can be below this low to be protected, so we should be good. But an open, a low, and a high and a close on 4-hour. So we are now creating a low. Look at how the candle is forming. This is the current 4-hour candle. An open, low, high, close. I want to see the next fair value gap coming up. We are accumulating, we're chilling, and there we go. So there is some price action. Let's see how the 4-hour candle is printed. And I think you could already take your trade right here. Stop below the low, 412. This will be the first entry. Let's see if we can get another entry. So based on this, there is some accumulation, and there's not many fair value gaps. So I don't like this too much to trade. So I'm going to be later. I'm going to wait until I see some fair value gaps. This is displacement. So here, at 6:30, here is where I would take my second entry right there. And what do we have as a target? Remember the liquidity video about all the failure swings? There we go. Low hanging fruit failure swings, I would say relative equal highs. So here we have a series of relative equal highs. It's all pretty nice. And look at time here. This is all Asia high. So I would say you can take this as a target, this Asia high. So you target session liquidity. It's pretty fine. So right here and right here. For the stop loss placement for this candle, I want to put my stop loss below the start of the 4-hour candle. For 1 to 2, let's put a little upwards for 1 to 2. Ideally below the low, but let's just do it like this. Let's see what price case says. So come back into drawdown. And we're approaching New York session right now. So we're almost stopped out here. So a little lucky here. That's why I need to have a good stop loss placement, ideally below these lows. And here we have another structure, so you can take another entry in the New York session right here. Stop below this low. And we are now approaching the New York open, 9:30. And at the start of the new 4-hour candle, look at 10 a.m., new 4-hour candle, we hit the TP point on both of the trades, exactly at 10:01. And this is more of a scalping model. Maybe less exciting because we were watching so many candles print and you need to wait for a while, but you could take an entry here, here, and here during the open, all based on a 4-hour open, high, low, close. And look again how this looks at the 4-hour. Look at that, how beautiful this candle prints. Let's remove the markers. Look at how we anticipated the low of the day right here in the overlapping order block and value gap, and the next candle prints higher. Based on this price action, I would say the 10 a.m. candle is also a bullish one. Why? Low of the day, 4-hour internal to external. Look at all the failure swings up here. So I would target the highs here. And let's see, boom. 10 a.m. candle goes to the highs. Makes sense, right? Failure swings. 4-hour internal to external. And here you have it, the open, high, low, close model. This is the exact entry model I use almost every single day to have a rock solid daily bias. And now you can use it to get funded, get payouts, get profitable. I created a free training where I break down how to get profitable and how to get to 100K and more in funding. I'll leave the link to that video in the description, so make sure to check it out right now. Thanks for watching. If you liked it, consider liking and subscribing, and I'll see you in the next one.